Okay, wow. We have some pretty unexpected, crazy news in the telehealth space today. This news involves two stocks, one of which is up over 200% this year and the other is up over 470% this year. Now, both stocks took a bit of a dive today on this news, but could this be a long-term buying opportunity? Let's talk about this crazy merger between Teladoc and Livongo. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking all things mergers and acquisitions. Our favorite stock on this channel, Livongo Health, has decided to merge with another leading telehealth company, Teladoc. And if you haven't looked at the markets yet, you might think, oh, this is some easy money, two big telehealth companies coming together. Not so fast. The market actually didn't like this one bit. In fact, before this merger news was announced, Livongo released a blowout earnings report that same morning and even touched $167 in pre-market trading. But because of this merger news, Livongo dropped as low as 15% on the daily chart once the market opened, and so did Teladoc Health. So let's break down this merger. Obviously, it's very important to the stock. Is it finally time to sell our dear Livongo Health, or is this just a chance to take one step back and 3 steps forward? Give me the format. First, if this merger is complete, what will happen to your Livongo shares? Second, why did Livongo do this? What was their reasoning? They were doing pretty well on their own. Third, comparing financials between Livongo and Teladoc to see if they're on par with each other. And finally, fourth, what I think of this deal and what I'm going to be doing next. As always, let's dive right into it with part 1. What will happen to your Livongo shares if this deal goes through? If you own Livongo, every share of Livongo that you own will be exchanged for 0.592 shares of Teladoc Health plus $11.33 in cash for every share of Livongo as well. This deal is expected to close by the end of Q4 2020, but it is still subject to regulatory approval and Teladoc and Livongo shareholder approval. And based on the market's reaction today, it didn't look like Wall Street likes this deal at all, and personally as a Livongo shareholder, I think Livongo is getting absolutely robbed and Teladoc is getting away with a steal, but I'll explain why later in this video. Part of me hopes that this deal will not make it through shareholder voting, but for now, let's talk about why Teladoc and more importantly, why Livongo wanted to make this deal in the first place. Alright, part 2, why did Livongo do this and what was their reasoning? Let's dive into Teladoc's press release for this merger. To set the stage, these are two of the fastest growing companies in healthcare technology today. This deal does help Livongo make significant progress on their mission to care for the whole person. And this is something I talked about in my previous videos for Livongo, so I'll link one of them right here. The co-founder and executive chairman of Livongo, Glenn Tullman, said this highly strategic merger will create the leader in consumer-centered virtual care. So Livongo and Teladoc are merging to create the leading powerhouse in telehealth technology. He goes on to say that this merger will accelerate the growth of their data-driven member platform, and by that he's referring to this. This is how Livongo AI works. It aggregates the data here, it then interprets that data and then applies it, gives feedback to the patient like, hey, you should do XYZ, and then starts this process all over again with new data. And now with this merger, Livongo has access to much more data from Teladoc. And as we know, when it comes to AI, the more data, the better. And finally, here's something you should pay attention to. Tullman says that this deal will provide shareholders with long-term upside as the combined company is positioned to serve an even larger total addressable market. By this, I believe he means that before the merger, Livongo's immediate total addressable market was limited to those with diabetes and hypertension, and eventually those with chronic illnesses. However, with this merger with Teladoc, Livongo and Teladoc's immediate total addressable market has been expanded to tens of millions of patients with a variety of different health conditions. And the last thing we'll pull from this press release is something I personally think is very important, and that is that Livongo and Teladoc share the same vision, corporate culture, and operating philosophies, meaning these companies should be able to integrate very smoothly and make meaningful progress together. Now, I also listened to the conference call discussing this merger, and inside I heard a couple more great nuggets of information. The first of which is that this partnership unlocks an incredible cross-selling opportunity. Teladoc, which has a vast customer network, can now cross-sell and promote Livongo products to existing Teladoc members and customers. Of course, this also works both ways. ways. And the most exciting part is that only 25% of Livongo and Teladoc's customers are overlapping, meaning only 25% already use both products. So the remaining 75% are technically and theoretically fair game for cross-selling. But one of the most shocking and intriguing things I heard in that conference call was they said, you need to smash that like button for Matthew because he's putting this video together within hours of the news coming out. Okay, I'm kidding, but not really. I would really appreciate it. These do take a lot of time. Thank you. But one of the most intriguing things that I heard in this conference call was that McKinsey, a trusted consulting group, recently put out a study saying that $250 billion of the healthcare industry could become virtualized, and that's just in the US alone. I went to verify this, and sure enough, here's the article. Up to $250 billion of US health spending could become virtual and make up roughly 20% of all Medicare, Medicaid, and commercial spend. $250 billion. As of now, Livongo and Teladoc have a combined market cap of about $30 billion, and telehealth, I believe, is still in its infant stages. So those are many of the reasons why I believe Teladoc and Livongo agreed on this deal, but what about the financials? How do these two stack up? Part 3, comparing the financials of Livongo and Teladoc. Financially, I think both companies are actually pretty great. Both have pretty stellar balance sheets. As of Q2, they're strapped with cash and carry very little in liabilities compared to their assets. Right now, you're seeing Teladoc's balance sheet with all that cash and small current liabilities. And this is Livongo's balance sheet with $685 million in cash and $471 million in total liabilities. In terms of revenue, Livongo saw a 113% year-over-year growth in the number of diabetes patients, they call them members, and 75% year-over-year increase in clients. This translated into $91.9 million in revenue for Q2 of 2020, up 125% year-over-year, which thoroughly beat analyst expectations. Now let's see how Teladoc did with their Q2 revenue. Teladoc saw Q2 revenues rise 85% year-over-year to $241 million, and total telehealth visits increased 203% to 2.8 million visits. And Teladoc raised Q3 guidance, raising full-year expectations. And raised guidance is always a great sign. So in terms of revenue, Livongo had a higher percent year-over-year growth, but Teladoc had more revenue in dollar amount, and that makes sense because Teladoc is a bit of a bigger company than Livongo, so it's hard for them to experience the same explosive growth that Livongo might. So far, financially, I'd say they're somewhat on par. But the one thing that bothers me about this merger the most is that Livongo is so close to consistent profitability. Now I know they're not profitable quite yet, but I think they're so close, and Teladoc has stalled a little bit in this department of getting closer to profitability. Over the past 6 months, Livongo has done a really good job at reducing its net loss, but Teladoc, on the other hand, over the past 6 months, has seen its net loss stay relatively stagnant. And that's what annoys me the most about this merger, is that I think Livongo could do so well on their own. They're almost at profitability. And if this merger news hadn't come out, I could almost guarantee their stock price would be somewhere around $160 today. But now, despite whatever Livongo does, to a certain extent, Livongo's stock price will now be tied to Teladoc's stock price until the merger is either complete or falls through. So now for the final part of the video, part 4, what I think about this deal and what I'm going to do. In the short term, honestly, I kind of hate this deal. As we just talked about, it's very limiting to Livongo's stock. And I think if Livongo stayed independent, we'd see much faster and clearer growth in both the business and the stock price. But in the long term, I think this is actually pretty good news. Teladoc and Livongo are coming together to form the dominant force in telehealth, an industry that is still in its infant stages but has been accelerated by the Rona. I think it is a great long-term opportunity for Livongo because Teladoc can open so many doors for them. I just kind of wish they did it a little later. So in summary, I'm really unhappy with the structuring of this deal, the pricing and the conversion of the shares and how all of that is playing out. I think Livongo, if left alone, could have continued this insane run-up that it's been having. But as a long-term investor, we have to think long-term, and I think long-term, it's good. So what am I going to do? Well, today I tried to take advantage of that dip we had, and I added a very small portion to my Livongo position. And by very small, I mean very small, because this is very fresh news. We don't really know how or if this will even fully play out, and I'm waiting for some more information before I really go in heavy, because I do think long term, This is fine, it's just a bump in the road, and maybe Livongo was due for a healthy pullback anyways. If you found any value in this video, please make sure to hit that like button, subscribe, and read our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. If you're still watching at this point in the video, thank you so much. You are the real MVPs. Don't forget your peace and thank yous.